Is the Fed finally done raising interest rates? This is, of course, the question on the minds of everybody watching the financial markets this week, last week, probably for weeks to come. We are just about a day out from what is, according to markets, the last one in this blistering rate hike cycle that we've been watching since the beginning of last year. And not surprisingly, if it were not that, if the Fed were to surprise the markets and show them, no, actually, this is not where this ends, well, then there would be quite a lot of repricing to do and quite a lot of volatility all across pretty much every major asset class, be it stocks, be it currencies, be it commodities, rates, you name it, it would be moving. If what the markets are expecting, with some smugness and some complacency, does not actually turn out to be the case. So let's take a look here. Let's put on our Fed policy official hats, look at what is actually in front of us here, and see what we might do were we Fed officials, and how that might look when the actual central bank announces what's going to happen. This is, of course, Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. We begin with where expectations have been going. In the red is the expectation for where rates are going to be at the end of the year. This is, by the way, not anybody's forecast. This is directly what is currently priced in to Fed funds interest rate futures. These are futures that are used to hedge against interest rate risk. There's, of course, any number of industries that need that hedging the same way a wheat farmer might hedge wheat prices because he or she is not sure that the harvest is going to be XYZ thing in a given year. So, too, somebody with exposure to interest rate risk might hedge it. This is one way to do that. And when we look at these Fed funds futures, we can back out then what the market expectation is for where rates are going to be. For December, we can see there's been a meaningful rebound since those lows in March and April. That was, of course, the banking crisis. They stayed low. Subsequently, we had the debt ceiling debacle. The gray bars that you see there are the difference between where rates are expected to be in July, that's this month, and then where they're going by the end of the year is that red line. So that difference, you can see, looked like significant cuts as recently as May, when markets were concerned about the debt ceiling at that point. You can see that since that time, there's been a significant convergence. Those gray bars have worked down to next to nothing and now flirt with the possibility, though not the likelihood, of a little bit more tightening. So if we look right here, what we see is here's a full 25 basis point rate hike. We've not baked that in. But at this point, there is a slight chance of one here. But as we see here, not fully baked in, and therefore this would make this July number, which you can see has been very steady in market expectations, even going back before June, that would make that the last rate hike. Looking at expectations here more broadly, we can see that for this meeting, the likelihood of a hike is 97%. So overwhelmingly, the markets think this is going to happen. But if we look at the implied rate, that's 5.32. So that's into the 5.25 to 5.5 range for the target rate. We are currently at the 5 to 5.25. So if we're over 5.25, that means there's been a hike relative to now. We can see then, looking out to November, the peak rate is 5.44. So not quite 5.5, and certainly not over 5.5. From there, the rates start getting lower. That it's not over 5.5, by the way, that of course means that this is the last hike. Because if we are then in a range between 5.25 and 5.5, we would need to get somewhere over 5.5 to signal a further hike beyond that. That's not what we are seeing here. So we peak out with a 44% chance for another hike in November. By May of next year, we're back to 5%. You can see the implied rate there, 5.05, which means we have given away the rate hike that we are about to see. So we've gone back under 5.25, having gone over 5.25, as you can see here, to 5.32 this month. So we're giving away this hike in May, as far as what markets are set up for. Then an aggressive rate cut cycle ensues, whereby we get between 3 and 4, leaning towards 4 cuts through the back half of next year and into the beginning of 2025, such that we're essentially back to 4%. So a full 1% lower than we are currently. Between May and through the back half of next year, that's 125 basis points in cuts, or 1.25%. So as far as the markets are concerned, to simplify this down, we're going to get this hike tomorrow, stand still until May next year, and then aggressive cutting. That's the baseline. Does that make sense if you're the Fed? Let's have a look. As ever, the main issue for the Fed is services inflation. We can see here that from the goods side, inflation has all but fully been squeezed out. That's that orange wedge from the beginning of 2022, coming down to next to nothing now. Energy is now a disinflationary factor. It's actually pulling inflation down, not boosting it up. Food inflation remains a little bit of a positive contributor, but is dwarfed many times over by what is being contributed by services. We can see where goods inflation went. If we look here at the orange line, that's the Fed funds rate, and we're using the futures here to see what it actually is in markets rather than what the Fed target rate is. So you can see there, as the Fed starts raising rates early last year, actual market rates start going higher. They are, of course, now in that 5 to 5.25 range, as we just said. 5.1 is where they actually sit. So as those rates rise, we can see overall global trade volume starts to slow. That's the impact of making economic activity more difficult to finance, more expensive to finance. As we've said here many times before, close to 80% of global monetary transactions are settled in US dollars, according to the Bank of International Settlements. Which means that when you raise the cost of borrowing dollars, as the Fed has done, what you do is increase the cost to finance virtually all economic activity, virtually everywhere. There's maybe the exception of, say, North Korea or increasingly Russia. But what you're looking at here when the Fed raises rates is an increase in the cost of financing virtually everything else. And that, of course, is going to be something that slows activity, because if something is more expensive to finance, less of it is likely to be financed. And so what you see here is, as rates rise, the turnover in global imports and exports starts to come down, as does inflation. That's that goods side going away. That's that orange wedge being worked down to next to nothing. Then, of course, there is the services component. And that's, for the most part, the labor market. Almost all employment in the United States is in the service sector. The spread between services and manufacturing is somewhere on the range of between 7 and 3 in favor of services, or 8 and 2 in favor of services, depending on when you look in recent years. So overwhelmingly, the problem here seems to be the mismatch in supply and demand in the labor market. What you see here is, with the start of COVID, labor supply vastly outstrips demand. That, of course, makes sense. Everybody's on lockdown at home while businesses are shuttered and the global economy is basically switched off for a while. And so there's all this labor and not much demand for it. As you start to get the reopening, you can see those tall blue bars, they work their way in. So the supply-demand imbalance starts to close. More businesses open, more labor engages with that new demand. And then as we get into the end of 2021 and the beginning of last year, the situation inverts and we start to have labor shortages. Part of this continues to be COVID hangover. For example, we have a situation here where the baby boomers that were retiring because they'd hit the age before COVID and that were somewhere on the cusp during COVID seem to have retired early in much greater numbers. That's also the largest contingent in the labor market by numbers. And so there's been, for at least this one reason, a dearth of workers. And so what we look at then, and of course there's other reasons, but that's one. What we've ended up with is a mismatch between labor supply and demand to the tune now of about 3.7 million. It peaked just over 5. So we've slowly been working this down, but as we can see, the mismatch is still tremendous relative to history, even recent history, where you can see that there was a bit of a mismatch in the run-up to the pandemic in 2018, in 2019, as that baby boomer retirement wave really started to gain momentum. Now, what we see then is, for all of the goods reasons that we've just discussed, inflation has come down from a peak of 9.1 June of last year to 3 June of this year. But it's this remaining wedge that needs to get worked out to get inflation down in a sustainable way to the Fed's 2% objective. Now, in so much as we're not going to magically create more workers, and there doesn't seem to be an appetite for a vast immigration wave, and we're probably not going to scale up AI to magically replace between 5 and 4 million workers by the day after tomorrow. the adjustment here is almost certainly going to have to happen on the demand side. From the Fed perspective, what this means is raising interest rates such as to slow economic activity, undercut demand for labor, and thereby to bring this market closer in line. In other words, it is to hurt economic activity, to restrict it such that labor demand is reduced and is closer in line with supply. So that's the game. That's what the Fed is looking to do, and that's why they're doing it. Now, does the market believe that they can succeed? Well, seemingly, that belief has been shaken. Because if we take a look at where markets are currently, we see that in recent months, measures of inflation expectations have started to idle. We can see that they front-run actual inflation by about 2 months here. So if we lag CPI by 2 months, we can see it lines up with both the 1 year expectation here, that's the 1 year USD inflation swap, as well as the 2 year break-even rate. That's a different look at inflation expectations from the vantage point of a different market, the bond market. Here we take the difference between nominal and inflation-adjusted bond yields. And when we do that, the residual is the inflation adjustment that is needed to get from one to the other. So that gives you the bond market's near-term inflation expectation. Again, as it is priced in. Not anybody's forecast, not anybody's model, not anybody's back of the envelope guesstimate. This is what is actually priced into markets. So what we see here is inflation in 1 year is expected to be about 2.4%. That's north of the Fed's target. Inflation in 2 years is expected to get back to the Fed's target at 2%, but just so, right on the nose. What all of this seems to imply is that absolutely nothing wrong is going to happen on the inflation front between now and 2 years from now. There is no margin for error here whatsoever. Now, we can very simply envision that Russia, let's say, reduces oil shipments, the price of oil pops, or some other such geopolitical thing happens, perhaps someplace else, and there's an inflationary shock. This could very easily get off course. From the Fed's perspective, that these expectations have stopped falling is probably the biggest issue. Because, of course, the Fed has continued raising rates. What this implies is that the market thinks the Fed has lost its ability, or is at least diminished in its ability, to influence inflation, and that it's not doing enough. In the Fed's world, they would, of course, ideally like to see the 2 year break-even decline well under its target. That way they could cut into it rising. That would be both economic stimulus at a time when they feel like they've won and they need to give the economy some more breathing room, having slowed it, and also would give them confidence that they're likely to land on target at a time when they want to be there. This seems to signal that the market is dubious about whether the Fed can in fact be successful unless everything is absolutely priced for perfection for 2 years and virtually nothing at all goes wrong. Perhaps the most worrying thing for Fed officials is that we've seen policy expectations shift higher, not just for this year. That orange line you see there is a running 12-month forward Fed policy outlook. In other words, what that's showing you is where the Fed thinks rates will be is at this point problematic. Because what the market is saying is policy expectations have been rising. That orange line has been going up. So rates in 12 months' time from any given point along that line are rising and will be higher. Meanwhile, inflation expectations haven't really moved and have been idling near that 2% level. So the reaction function to Fed action seems to be broken. Something Fed officials, needless to say, should be worried about. Now, we just got some PMI data earlier this week. It seems to suggest that maybe the pain that the Fed wants to be inflicting is starting to work. So we saw that from about December of last year, the services sector really diverged upward from manufacturing. And that's that goods versus services dichotomy in inflation. Goods have been squeezed out, services not. Now, in the logic of PMIs, 50 is the center line. That's the level at which there is neither growth nor contraction. Under 50 is contraction. Over 50 is growth. So you can see here that manufacturing slipped into contraction territory already by the second half of last year and has largely stayed there. So that red line is hanging out under 50 for the most part. There's one spot there where it tried to come back. Services, though, and because services is such a dominant part of the economy, with it, the composite, started to diverge around December. Starting from May, that divergence seems to have crested, and services are now slowing and pulling the overall economy lower. That would generally line up with the Fed's reckoning that a single rate hike takes about 12 to 18 months to be absorbed in the overall economy. So if we start the rate hikes in March of 2022, and we really start to see them bite in earnest domestically for the service sector around May of 2023, that seems like it lines up for the most part. So maybe the process that the Fed wants to be having is being had. But that doesn't seem to be enough. Because, of course, what the Fed needs to do is to prove to markets that it's being had, and therefore to get inflation expectations lower. That seems to be a taller order, because if we look at how U.S. economic data has been performing relative to baseline forecasts, it has actually been significantly better than expectations hold. Those expectations, of course, are the very same that have the markets thinking that we are going to have this massive rate cut cycle in the back half of next year, and that this is indeed the last rate hike. But what the economic data seems to say is, well, maybe not. Maybe all this economic data continuing to surprise on the upside means the Fed hasn't squeezed enough, or at the very least, maybe they'll hold rates higher for longer before they begin cutting. And so convincing markets will probably take this rolling over. Now, from the Fed's perspective, the cost to doing something is also, of course, an important consideration. If they go too hawkish, might they restart the banking crisis? Might they break something else? Well, on the evidence, it would seem that what's going on here is actually the easing of financial stress. At the same time that Fed rate hikes are rising, and that generally reflects the banking crisis being mostly contained, the debt ceiling debacle ending up as not an issue, at least near term. And those rate hike odds recovering because risk of those events going wrong has receded. But at this point, the Fed seemingly has an open window to say, well, you could get more hawkish without really upsetting the apple cart, because financial risk is muted. Now, looking over the past week, the markets seem to have picked up on some of this. And what we've seen is the yield curve has started to shift out slightly in a more hawkish direction. So we can see the solid line there is a little bit steeper, a little bit higher than both the lines for where we were after the last FOMC announcement mid-June and as relative to a week ago. So there does seem to be a bit of a hawkish rethink here starting to carefully and cautiously occur. And we've seen what's happened in markets since then. Stocks have stopped rising. The dollar has rebounded. Gold has pulled back. Yields have crept back a little bit higher, having lost quite a bit of ground. If the Fed comes in tomorrow and their thought process is largely as we've described it here, well, then it doesn't cost much to be more hawkish, yet there is a need to do it. And so it's not so much that the Fed needs to hike larger or do anything different than what is already expected for this move. That much seems all the way baked in. But if the probability of further tightening increases from, say, 44% to 60, 70, and the rate cut path is pushed away from a start in May to, let's say, somewhere later next year, that already would be a meaningful enough shift to give us more of the same. That is, of course, a stronger dollar, higher yields, perhaps a soggier response from Wall Street. And that is Macro Money for today. Thank you very much for joining me. As ever, I am here Monday through Thursday right after Futures Power Hour, which is a show that I do with Chris Vecchio, head of Futures and Forex here at tastylive, where we recap today's events and attempt to make sense of them. I'm also on with Chris for Futures Power Hour. I'll be on tomorrow for a special session before the Fed, but usually on Fridays. And I will be on Sundays with Tom and Tony for First Call as well. Outside of those shows, I'm writing for tastylive.com under the News and Insights section and opining on Twitter at Ilya Spivak. That's right, Twitter. Not X, Twitter. Thank you very much for joining. See you tomorrow.